Okay, good afternoon, everybody. For those that don't know me, I'm Kirsty McKenna. I'm the Innovation Programme Lead at FinTech Scotland, and I'm delighted to be spending the next hour or so with you. For those of you who are not familiar with FinTech Scotland, we are an independent, not-for-profit cluster management organisation. And what that means in practice is that we work across Scotland, the UK, and more so now internationally to create and grow a collaborative environment for large financial and professional services organisations, large technology organisations, the academic community, regulators, policy influencers, and local and national government agencies to bring together. Now, we have a strong and growing community of about 250 entrepreneurial fintech businesses across Scotland, and collectively we're progressing a tech and data positive environment to support and create economic impact across the UK. Now, a really key enabler for FinTech Scotland is the Financial Regulation Innovation Lab, or FRIL, which is now in its third year, which is a fantastic programme which is led in partnership with FinTech Scotland and two incredible Scottish academic institutions, the University of Strathclyde and the University of Glasgow. FRIL is an industry-led initiative which creates practical collaborative spaces where innovators, academics, business and policymakers can come together to solve real and relevant industry challenges, spark fresh thinking and drive tech-powered efficiencies and change in financial regulation. Now, there are a number of key elements which power FRIL and Sopra Steria have been at the heart of our programme across a variety of the work streams. FRIL works on a thematic basis, working on the priority topics for industry to explore and test the art of the possible through pragmatic innovation challenges, bringing innovators and industry together. And Sopra has played a key role in this space across a variety of topics. And our FRIL academics also work really closely with industry to progress the latest in academic thinking across these topics and work hand in hand with colleagues across the programme to advance our collective thinking on vital topics. So today, we're diving into the topic about how innovation can truly put consumers at the heart of the financial system. With rising debt and increasing vulnerability across UK households, it's more important than ever to go beyond compliance and ask, are we actually improving financial well-being? And to explore that topic further and to talk about the white paper that's been developed, I'm delighted to be able to introduce colleagues on this call. So without further ado, Cal, can I hand over to you to introduce yourself, please?
Yeah, of course. Thanks, Kirsty. I'll just change the slide, which, as always, doesn't work as intended. So, hi all. I have the pleasure to be joined by fantastic academics and innovation leaders. I have two roles at Sopra Steria. One of them is my I would say primary role working with private sector clients, in particular financial services, to employ technology and science in supporting decision making as well as transformational projects and building efficiency across the board. So I work on data science projects, data analytics, and even what I like to call data-driven visual storytelling. My other hat, which is, I suppose, more relevant to this session today, is the head of the function that we have internally at Sopra Steria UK, which we call Academia and Research. We collaborate with numerous academic institutions across the UK. Glasgow University is one of the main players in this space for us. Other names are Strathclyde, again, through FinTech Scotland's Innovation Lab, also Edinburgh University, our oldest partner, as well as Oxford and others. So we have delivered about 15 R&D projects over the last several years. We also support practical courses, student competitions. We deliver guest lectures, workshops, seminars, ultimately with the idea to bridge the gap between academia and industry, which I'm delighted to say that's already happening everywhere in the world. So yeah, I have the pleasure to work with great minds from both academia and industry who are extremely knowledgeable, not only in the financial domain, but in a variety of different sectors, and of course, excellent specialists in the technical areas. So over to John, I suppose.
Thanks, Cal.
Good afternoon, everybody. I'm John Finch. I'm Professor of Marketing at the University of Glasgow's Adam Smith Business School, and I'm the lead investigator on the Financial Regulation Innovation Lab for the University of Glasgow, contributing to our partnership with FinTech Scotland and the University of Strathclyde for this wonderful project that has completely changed my outlook and research activities and allowed for the kinds of collaboration that we're going to present today, which from an academic point of view would not have been possible without this project. So here's to a fruitful conversation continuing, and one that we've been having over the last couple of years, and happy to present now.
Thanks, John. And Dan.
Hi everyone, I'm Dan. Thank you very much for having me. It's very nice to get out of the academic world and talk about the real world for a while. I used to be a lead associate at the FCA, and I led the work on the overdrafts evaluation, which is referenced in the white paper. And now I'm doing a PhD in the area of household finance, which broadly studies anything to do with retail financial services markets.
Thank you very much, Dan. So I have the joy and the pleasure this afternoon of being able to interrogate, I'll say, our panelists. And I have about 5 or 6 questions that I'd really like to discuss with the guys. I was remiss at saying at the beginning of the webinar, the opportunity to ask questions is available to all in attendance. So on the right-hand side of your screen, you should be able to see or have the ability to ask some questions. And we will also be running some poll questions ourselves throughout the session. So we're really interested to see your reaction to those polls. So just keep a wee eye on the right-hand side of the screen and ask any questions that you would like to do. Okay, so thank you guys, and thank you for your contributions to the paper Consumers at the Heart of Innovation. It really is a great example of the collaboration between industry and academia that can come through programmes like Frill. Cal, I'm going to start off by asking you a question. So more and more so, we're having conversations about financial health and consumer well-being. Why do you think evaluating that consumer financial health is becoming more important? And how different is it today, or how different an approach is it to traditional credit scoring in terms of financial health?
Yeah, absolutely. I think this is the best starting question, simply because I'll start off with a simple figure: £17,000. That's the average household debt in the UK today. We explained that in the white paper, and it's concerning. I'm sure everyone would agree with that. Just for comparison, I did a simple calculation to figure out what the average net income is in the UK, and it's around 22k. So it's and that's annual net. So it's also important to remember something, that when the UK was part of the European Union, the majority of the unsecured debt was accumulated in the UK. So that means that people spent a lot of money that's not theirs. And whilst that's okay when you have the ability to repay, sometimes what banks use, the traditional credit scoring, relying on backward-looking metrics, is not sufficient. I would actually go further and say it's not adequate in today's reality. Having all the geopolitical and macroeconomic instability, we have to be more resilient as a society, and that's where financial health comes into play. It's not a formal definition as such, but what it means is that we need to have a look at the holistic position that people are in. So we need to take into account everything financially and even non-financially related that's relevant to how much they can afford in order to remain in a relatively healthy position, and consider this as physical health. I'm sure we'll talk about this later. When we go to regular checkups and we find out that something is wrong with us, we make we have preemptive prescriptions. We make some actions and changes to our lifestyle in order to get better, right? So it's pretty similar. I'll give you an example to illustrate it. So imagine if someone has, let's say, a total credit limit in credit cards around 20K, and they persistently use, let's say, 8K. That's below 50%. So from the credit reference agency's perspective, that's fine. And imagine they are close to retirement, but they haven't repaid their mortgage. Let's say that they are low to mid income, etc., but they've never missed a repayment on their loans, etc. That means that according to traditional credit scoring, there'll be perfect example of credit worthiness. That means that most lenders would like to give them more and more, to lend them more and more money. However, compare this to someone who had, let's say, a few years ago, they had a missed payment simply because they lost their job or something, but they have the totally opposite behavior towards savings, etc. If the first person has no savings or limited savings, risky investments, luxury cars, unnecessary spend, etc., and the second person is really well, very disciplined in their financial management, but had a missed payment, most likely they'll have a lower credit score based on the traditional scoring. Is this the best way to evaluate it? I don't think so. So times are changing, and we need to build a more resilient and inclusive future and sustainable future for our society. And I'd say it's no longer a must-have. It's a must-have. It's no longer a nice to have. And the important thing is that it's not only about people's financial health. Financial firms will benefit in the long run by maintaining a healthy portfolio of customers, and ultimately the whole economy will keep growing in the right direction.
Thanks, Cal. Dan, this is obviously a key area of expertise for you. Any reflections that you'd like to add?
Yeah, I want to agree there with Carl, because I think I missed a payment on my gym membership 3 months ago, and now I'm punished with slightly higher interest rates on another loan that I have. So absolutely. I think that I'm not exactly familiar with the history of credit scores, but I think there's a historic element there. So this is how things have been done for years and years. And I think that there have been historically some data constraints to the credit scoring companies. So the reason why they didn't take a more holistic view and only looked at historical data when assessing people's ability to repay was because that was the data that was available to them. So they did not necessarily have access to the information about the people's liquid assets, about their income, and so on. And now, with better data infrastructure and just better data availability, this is becoming more and more possible. So I absolutely think that we should embrace that opportunity to have a more comprehensive and better informed credit scoring.
Thanks, Dan. John, any perspectives you'd like to add?
It's an important subject, of course, and I think so far what we're seeing is others legacy questions that my colleagues Dan and Cal have just pointed out. And I think also the thing that overhangs this to some extent is the financial crash of 2008. So perhaps a lot of this is legacy driven from that macro risk divided into the individual activities of, what's it like to create citizens who are debt carriers, and what's the filtering process that's going on there at that time. So I think, there are a whole range of legacy issues here and historical concerns built into this process of credit scoring, when in fact, what are we really trying to do? And I think if we put the macro position now in those stark terms of the kind of borrowing behaviors that we notice or the aspiring borrowing behaviors of many citizens, then what are we creating now, and is that fit for purpose with a better, perhaps more robust regulation following the concerns of 2008, but now moving into a current setting, what sort of financial citizens are we creating in this process now? And hopefully that's where we signal around in the white paper too.
Thanks, John. And keeping with that theme of sort of looking forward and changing expectations, Dan, I'm going to come to you first on this one. And I also believe that a poll might pop up shortly, so keep a wee eye out for a poll to be filling in. But Dan, what would be your reflections on how sort of regulations like the FCA's Consumer Duty, and in fact the broader sort of landscape, are reshaping expectations around financial health and innovation, and how innovation can support financial health?
Thank you. I would like to talk a little bit about the overdraft intervention from 2020, because that was really the precursor to the kind of things, or it was like a test run to the type of regulations that we see in the Consumer Duty. And that was the first large intervention where the FCA moved away from the traditional model of just giving some sort of rigid rules and then monitoring compliance against those rules. The particular thing that I'm talking about is the goal of the policy that aimed to reduce the incidence of people that use their overdraft for long-term borrowing. So in the traditional regulations, this regulation would have looked something like anybody who uses an overdraft for an entire month consecutively is treated as a repeat user, and therefore any bank that has such customers should send them a communication in the form of a letter to inform them about the harms from using overdrafts as a means of long-term borrowing. Instead, what the FCA did was to give freedom to financial institutions to make their own definition of what it means to be a repeat user, and also give them freedom to define their own means of intervention. So banks were free to kind of choose the style of communication that they sent out to their consumers. And this approach to regulation has both benefits and drawbacks. The benefits is that it's much more flexible. Banks can choose these parameters based on the needs of their consumer base, and they have a very good overview. They know their consumers very well. The drawback is that some financial institutions might actually do the bare minimum when it comes to implementing such a policy. They might have a policy in place, but there's no guarantee that they have really analyzed the impacts of that policy and that they have analyzed the actual impacts on consumers' financial well-being from that policy. The white paper published by the colleagues here actually very correctly concludes that the Consumer Duty is a first step towards actually compelling banks to not only do a tick box exercise, but commit them to actually analyzing the outcomes for consumers. So I think going in the future, we're going to see the onus being put on financial institutions to monitor and come up with better measures of financial health.
Thanks, Dan. John, anything that you'd like to add to Dan's reflections there?
Yeah, there's a couple of observations. I think one of the interesting parts quite early on in the documentation for the Consumer Duty is an aspiration stroke objective that through the Consumer Duty there will be a reduction of complaints that make their way through the process and end up with the United Kingdom's Financial Ombudsman Service. Now, together with my colleague Chuck Sotioma, we've written a companion piece to this as another Financial Regulation Innovation Lab white paper where we look into some of those details. Now, it's very early to say. Clearly, there's a lag here. Although it was interesting to see in the Financial Ombudsman Service reports quite early on after the launch of the Consumer Duty, the reports were beginning to take on board some of its objectives. Now, whether or not we're actually seeing a reduction in the number of complaints, that's obviously something that we'll have to have a lagged analysis of. But some of the interesting points that it brings out are some of the practices that look quite similar. So for example, we've got this idea of sludge practices, but we also have friction. Now, they look roughly the same. It's the provision of time for consumers to make decisions in the consumer duty world, and what the financial service companies are doing to support them. Although both involve the use of time in which information can be digested, yet sludge practices are deliberately slowing people down in trying, for example, to exit or change, whereas the friction is much more about those sort of cooling down periods. Now, I think as we develop the conversation a bit further, I think both of these are interesting areas where we can look at the practices of consumers themselves and their influencer groups and their support systems, as well as among companies and emerging fintechs, in how they make use of this time and information, whether to reflect and make better decisions, or to become even further ensnared in processes that are perhaps opaque and not as informative as ideally we would like. So I think they're the couple of the angles that come out of this with respect to the consumer duty, and from the lens of the aspiration of reducing complaints through to the UK Financial Ombudsman. Clearly, complaints have to go through a long process before they get there. It's also interesting to know how far ahead the UK is than other jurisdictions in the rest of the world in this. And I've presented some of this internationally, and people are really interested in this approach of the consumer duty because it's different and arguably more advanced than in other jurisdictions.
Okay, thank you, John. In the interest of time, I'm going to move on to my next question, which I believe is going to spark off another poll. But John, sticking with you for a wee moment, and then Cal, I'm going to ask for your thoughts on this one as well. I'm keen to understand what, from your perspective, John, it will take to shift the financial service industry from compliance-led approaches to really, truly customer-centric approaches, and where you think we are on that journey to date.
Yeah, I think we're in an interesting place at the moment with quite a lot of variance. But I think the consumer duty has stimulated a lot of thought among some large financial service companies. So I'm a marketing professor, as I've mentioned, and I regularly attend the Market Research Society's Financial Services Conference, which is a practitioner workshop, seminar, annual. And one often hears from insight professionals who are working within large financial institutions, sometimes in collaboration with fintechs and other services, sometimes with social enterprises, in order to really embed those understandings of that financial health, or as we're going to come on to, vulnerability, and how this is being understood, beginning to be understood in a much more sophisticated way within some financial service companies, where insight professionals are beginning to develop specialist groups, partly influenced by the consumer duty and compliance, but going beyond that, because as a group of professional marketers, we're just genuinely professionally interested in the segmenting, in the behaviors, and in the vast array of data that's being made available, becoming available through the normal activities of people coping with their and engaging with their current financial products. I think one thing, though, that is becoming clear is definitions of vulnerability, which I think is behind the consumer duty, but is also behind a lot of innovations within financial service companies, as reported, for example, among insight teams in places like the Market Research Society meetings. And these definitions of vulnerability are very much about coping in the moment, coping at that moment in time. I mentioned those time elements like sludge practices and friction. Within those time periods, the idea of vulnerability is not so much protected characteristics, or that has a bearing. It's much more about the access to external capabilities, cognitive support that consumers, users of financial products and services, have access to at particular moments. One can be vulnerable because one doesn't have directly or through social networks that capability to interpret and understand necessarily the kinds of products that are coming their way. I think one of the things we've identified through the Frail project as well is the coming challenge of how people begin engaging with their pensions and drawing down of pensions. And I think that element is really going to stimulate some of these discussions around complex, long-lasting financial products, again, referring to the idea of vulnerability, of how consumers cope in the moment, in the context, which may or may not be influenced by any particular structural standing they have with respect to any protected characteristics, which we're very familiar with and absolutely should be working with as well.
Brilliant. Thanks, John. And a nice wee plug for an upcoming piece of frill work on the advice guidance boundary. Cal, can I perhaps ask for your thoughts on this topic?
Yeah, absolutely. I think picking up what John just said and also what Dan covered earlier, it's important to say that compliance itself, compliance alone, it doesn't deliver any better results around financial health. It shouldn't be considered as a tick box exercise, as we repeatedly say in our paper and elsewhere. You know that when we talk about physical health, we can say that healthy society lives longer. So it's pretty similar or identical when we talk about financial health. That means that the economy grows. That means that people's living standard increases. Ultimately, what we had in the name of the paper, at the heart of the customer's needs, etc. That's not just a slogan. It must be operationalized. And the point is that John just mentioned the tailored guidance. That's a fantastic opportunity. So the FCA is enabling this. So you know that in order for you to provide financial advice, you need to be, so it's very heavily regulated. You need to be pretty certain in what you provide. You take the full responsibility, etc. However, in the era of AI, generative AI in particular, and all the technological and scientific advancements, we have a lot of opportunities to build, for example, typical personas using behavioral science and all these nice things. And the point is, we can offer tailored guidance to people based on their similarity with certain personas. Of course, a very important thing there is that whatever methodologies and algorithms we use, like machine learning, etc., it has to be explainable. Black box models wouldn't work. And the point is that when financial firms want to center everything around their customers, which ultimately they'll have to do anyway, they need to make sure about how they explain this transparently to these customers, how they motivate the customers to take certain actions. Because back to Dan's point about the heavy overdraft users, I remember working on a project for one of the major banks in the UK. I was looking through the data sets, and I was astonished to see people keeping -8, -10,000 pounds in overdraft, with the standard APR being almost 40%. So that's insane. And if these people are given tailored guidance, which is based on scientific and technological principles, and they're given the full explanation so they can trust the bank's guidance, then I think this will ultimately shift everything towards customer-focused product development.
Thanks, Cal. And a topic that comes up often, and obviously the use of AI requires data to train that AI, to train those models. But sort of in the advent of open banking, and as we move more into a world of open finance, how do you think those capabilities can help to drive better outcomes for consumers' financial health? Cal, I'll stick with you on this one.
So one of the main difficulties around evaluating holistically people's financial health historically has always been the fact that it's really hard to know what this individual has in terms of current accounts across multiple banks, what their pension is, insurance, and all the variety of things, the financial products. Open finance changes everything, really. But it's important to say that open finance is not a new concept. As most people on the call are probably aware, it's kind of an extension of open banking. Now, there was an FCA sprint around open finance and what the future looks like in 2030, which brought together experts from academia, industry, public sector, etc. And I saw some compelling use cases. We're talking about, yes, financial health is a perfect example around lending decisions, making sure that people have opportunities to grow their net worth and all that. But also things like think about bereavement use cases, for example. Open finance will make it possible for people to keep all their financial data in the same place. And something very important, the reciprocal approach would definitely allow the financial firms to have access to a lot more holistic view of their customers, hence not only give them tailored guidance, but also make sure that they have a real life opportunity to track the macroeconomic impact on their customer base, for example. So that's really important, because this 360 degrees overview is relevant to both the individual consumer and the financial firms. And something else actually that I think is crucial to mention is that open finance is kind of the midway through the journey to open data, or smart data, as some people refer to, which will add more things like utilities, etc. So things are changing. There is no way back, even though some people complain about it. For example, bringing back the experience from open banking and the fact that it costed a lot. But that's why I said it's open finance is an extension. So we're not gonna reinvent the wheel. It's just making sure that this time around everything is structured properly and efficiently, and there is all the security and privacy required around the access to all data. So yeah, I think that's my view on this.
Thanks, Cal. Dan, any thoughts that you'd like to add on the topic of open banking, open finance, and outcomes?
Thank you. I'll give a kind of aspiring academics perspective on this. So my particular research project that I'm working on right now attempts to answer the question of why do people use high-cost credit when they have available liquid savings? It doesn't make any sense. People are not getting any decent interest rate on a liquid savings account in a bank, but they're paying a lot for an overdraft or a credit card. And people have known that this behavior was kind of prevalent among a very significant part of consumers for like the last 30 years. But the very first evidence about this came from consumer surveys. So these surveys would sit the person down and ask them, okay, in the last 12 months, how often did you have a chargeable credit card balance? And how often did you have savings in a liquid savings account? So they've known about, things where consumer welfare can obviously be improved in cases like this. But in order to actually understand the reasons behind it, this sort of survey data is not good enough because it relies on consumer recall and so on. Now with open finance, one of the academics that I work with, she's called Arna Olofsson. She has data from a financial aggregator app from Iceland that she's been able to answer questions like this one very well, because there you observe exactly when consumers make these decisions that might not be in their best interest, and it's you're in a much better position to kind of build and test theories about the reasons behind those behaviors. And that is extremely important for the regulator as well, because in my particular case, why do people use high cost credit when they have savings? It's very important to know, is it because they don't have very good financial education? Is it because they don't have very good information? Are they doing it because of convenience? The answers to these questions will then determine the correct regulatory approach to address such behaviors. And that is just one example. My area, again, is consumer finance, and that is fraught with examples of consumers not making the best decisions. That happens in insurance, in mortgages, in high-cost credit, in investments. So I think that, from an academic's perspective, this is a great resource to answer very important questions about consumer behavior. And also from a regulator's perspective, that what comes out of this research can really inform better regulations.
And then it's a great reminder that we can have all the data in the world, but actually it doesn't necessarily tell the complete story, and we really need the voices of the consumers and those consumer groups and the lived experience to help shape that story. Cal, you had
Yeah,
your hand up.
apologies for taking the mic back, but Don inspired me uh, with what he just said. So I'm thinking, even from the individual behavioral science perspective, it's quite interesting. I would use a metaphor. Think about open finance as a smartwatch with all the relevant apps associated with it. So we used to have like step counters, etc. back in the past. Now using the smart watches, we can check our pulse, we can check our stress levels, how we sleep, etc. And this can drive our decision making. It can drive the changes in our lifestyle, and we can track over time. We can track, monitor the improvement. So that's everything that I can say about open finance. It gives us all we need to make sure that we make informed decisions, and also we can monitor everything over time.
Thanks, Cal. You've started a trend, John.
I put my hand up too because I can. Because I think, you know, the point I wanted to raise under this subject was thinking of this almost as a value chain or a value network. And I think what we're needing to see is a change in perception from financial service providers, and some fintechs and challengers can do this. Are we making stuff in advance and then marketing it and selling it, or are we making much more adaptive products closer to the experience of consumers and users, and taking into account and adapting products and services in the face of user experience? Now, I think, again, we've spoken a lot about overdrafts and perhaps more short-term instruments, though these can become structural. We can extend this to the world of pensions or longer life provision and longer life financial health. Let's be clear. I mean, pensions are not a luxury that everybody can gain access to beyond minimal provision from state systems. So to some extent, where I want to go with this is to say, well, the open banking is also from a consumer's point of view. What of their behaviors are we picking up? Consumers as innovators is the of a project that the related paper that Chucks and I have written, as I mentioned, to focus on the innovative behaviors that we are perhaps anticipating of consumers and their capabilities to switch between complicated financial products, to know their goals. A crucial part of kind of the consumer duty is that consumers know their goals, because financial service companies need to address consumers' goals. Well, these are really complicated things for us to put at the consumer end of this value chain, value connection. And I think what open banking, open finance does, and I think I was hinting at this and to some extent as well, is that perhaps it also puts better information in the hands of consumers, consumer groups, consumer advocacy to cope with that switching across different products, different portfolios. The only thing that concerns me, of course, is that perhaps the consumer duty is still very much on the consumer to product connection, and not on the portfolios across multiple companies and providers, including state ones, that consumers could be juggling with. So how can we extend a little bit further into assisting those consumer behaviors in coping with an array of really complicated timelines, products and services, and some of which may be out of reach at the moment, and how does one even bring them into reach?
Thanks, John. And you've actually led me really beautifully into my final question. But before I do that, I'd just like to remind everybody on the webinar that there is the opportunity to add your own questions on the right-hand side of the slide, so the right-hand side of the screen. So if there's been any sort of nuggets of that spark some thoughts or questions, whack them into the question box and we'll come to you shortly. But before we do that, and John, you've alluded there to some of the both challenges and opportunities. But for all three of you, John, I'll come to you first, then Dan, and then Cal. Can you articulate what you think some of the main challenges and in turn some of the main opportunities that are in fostering innovation that improves financial well-being in the UK, whether or not that's for the consumers, for the regulator, for the financial services industry, or for perhaps fintechs? What do you think the main challenges and opportunities are at the moment?
Okay, almost to go back to the beginning of the discussion here, there is a transition from the macroeconomic into the individual consumer experience, and I think that interaction is absolutely critical. As a challenge, I don't have any great ways of actually solving it like this, but it's certainly some connectivity that we all need to bear in mind. There's aggregate statistics that Cal began with, and those objectives across financial regulation that Dan alluded to are of critical importance as we flip between a macro view of the economy's performance and the micro experiences experienced across a wide distribution of consumer experiences. And I think the second element here is the innovation is much more about enhancing those capabilities. Going back to my remarks about vulnerability, a situated, contextual, and in the sort of extended think space that consumers cope with. How can we extend innovative products, a bit like the smartwatch example that Cal came with?
Mm-hmm.
What can we do with our financial products around smartphone, assuming consumers can have access to these, to track and comment on performance, to add that layer of reflection that perhaps one gets from a heart rate monitor or something? What's that feedback that we can provide as part of our financial service? And let's look at some test cases. The use of overdrafts for structural questions, or that kind of drawdown of pensions, could both be really good test cases around this.
Thanks, John. Dan, I'm going to come to you next with the same question. Where do you see the main challenges and opportunities at the moment in the current landscape?
Thank you. I think people will not think that I'm being too cynical, but I think we need to recognize that when we talk about financial markets, we're not talking about the markets for potatoes. If you go to the shop and you are not happy with a particular brand of potato, you just go to the other shop and buy another one. In the data that I'm working with, I see extremely low rates of switching. People never change their accounts, even though there are accounts that offer much better interest rates. And there's many other pieces of research that point to the same thing. And that comes down to the fact that financial services markets are very often markets of what is called a monopolistic competition. So it's not exactly a perfectly competitive market. That means that sometimes convoluted pricing structures, difficult terms on financial products could actually result in very big profits for certain financial institutions. So we need to be aware of the fact that there might be interest in pushing against innovations such as open finance, which could potentially result in people shopping around more, being much more proactive in choosing financial services. So it's just the structure of the market that is we need to be aware of. And I'll just mention another challenge. It's just very difficult to understand exactly what the driving forces behind some consumer choices are. And just the technology is not difficult enough. John mentioned something earlier about open finance not necessarily leading to better outcomes. In fact, one of the research papers by my colleague Arne Olofsson shows that people that use a financial aggregator app, they have it's at the tip of their finger to switch to a better savings account, do not do it, even though an account that has the exact same terms but a higher interest rate is available to them, they don't do it. And to change this, we really need to understand what are the kind of factors that drive people's behavior, and that is not a trivial question.
Yeah, that goes back to the lived experience and the consumer groups and understanding the underlying behaviour. Thanks, Dan. Cal, can I ask the same question to you? What's your view on opportunities and challenges?
Yeah, certainly. I think one of the common challenges is something that we keep mentioning every time we have the opportunity to, and that's the public trust or the lack of it at times when we talk about financial products as well as providing or giving consent for your data to be shared with third-party providers. Now, this is not a challenge that we'll solve on this call. It's something that requires a lot of consistency and very strong collaboration across fintech regulators, consumer groups. We should all be heading towards the same goal, which I believe is how I see it today. I think there are a lot of visionary projects that bring people together and make sure that everyone is fully aligned. So I think that's, in terms of challenges, that's my main point. Um, in terms of opportunities, now, most of you are probably aware of the FCA sandbox, etc. But I'd like to put a highlight on what Thrill does, like bringing together experts from the public and private sector and heavily supported by excellent academics. That's the kind of collaboration that I just mentioned a minute ago that we need, and it's actually a must-have in the future because academics, to some extent, are best positioned to do that holistic evaluation of what the products look like, whereas we, from the private sector perspective, we know what the individual consumers need. So joining the dots is great, and it has to happen more often. And the other thing is the science. That's something that I keep, in the era of generative AI, and every second person talks about AI these days, but the underlying science, that's actually what I care about, because there is a lot of heavy mathematics underneath. And for example, I'll give you an example. If you want to build a holistic financial health model evaluator, you need to go, especially with open finance in place, you need to go and cherry pick, let's say, 10, 15 data measures out of thousands. How do you do that? That's a scientific problem that a lot of people work on, and there is no simple answer to that. So it's exciting because you don't know whether the last 6 months of average credit card balance is more important than, let's say, whether you own a house or not. You don't know if life-changing disclosed events are more important or less important than your pension pot balance and things like that. So there are a lot of scientific questions to be answered there, and that's where I would classify this as opportunity, as long as more people want to get involved in the heavier subjects, especially when you select, for example, select and evaluate different, let's say, machine learning algorithms. You need to think about performance, explainability, back to the earlier points that we all raised about making it more digestible by the end user. Also, when you do the risk categorization, how would you say that someone is in the red category or amber or green? How do you define the thresholds between them? Do you use clusters? What about macroeconomic factors, for example, high inflation or times of recessions that will ultimately shift everyone's financial health evaluation? All these questions, I would group them up and call this opportunity for all of us.
Thanks, Cal. And I can see that we've got a raft of questions coming in. So in the interest of time, I'm going to start working my way through some of the questions on from the attendees of the webinar. There's an interesting one on risks around third-party AI models, and this relates to the point that you were just making there, Cal, about explainability and trust in AI. So Dimitar asks, multiple financial institutions are using the same third-party AI models for financial health evaluation, and that creates potential concentration risk. If a biased or flawed AI system is widely adopted across the industry, how should regulators prevent systematic discrimination or market manipulation? Now, that's a big old question, but Cal, thoughts on that, please?
Yeah, that's one of the things that when I mentioned the personas earlier in one of my responses, I was hoping that nobody would ask this question because it's really hard to answer. So as many things in the financial services industry, we rely on regulators and auditors to make sure that there is no bias. But in the era of AI, this is a growing concern. So what I think will be the most important feature of such models is to incorporate live feedback from consumer groups. Now, it can be biased and on its own, but it will potentially balance all this potential shift towards something that, as the individual said, may even lead to risk around market manipulation. So it's kind of similar to the markets, the Wall Street, etc. Yes, you can manipulate the market, but for a short period of time. So yeah, we need controls, systematic controls.
Thanks, Cal. So next up, I've got a question I think I'm going to direct to Dan in the first instance, and then ask John for his reflections on too. And this comes from Grace. So how do you think financial institutions should tackle the issue of engagement with services available? Often the most vulnerable in society are the least engaged with the financial services that are available to them. Now, Dan, you touched on this when you were talking about switching products. What do you think about the issue of engagement and how financial services can do more there?
Thank you. That's a great question. It's super important, and I know from my time at the FCA that the FCA actually does look a lot into this against sludge practices. A lot of regulations are rolled out for presenting information in a standardized way that makes products more easily comparable. And there is evidence that does work, but it's absolutely correct that there are some cases where it is very hard to make people engage with their financial services products. And I think that reducing sludge is not the end all be all. There are definitely certain cases where stricter regulations are needed. So, for example, with overdrafts, and I'm sorry I keep talking about it, but that's what I did. One of the elements of the regulation was to require banks to price everything via a single interest rate, and because of that, a lot of products that seemed very cheap on the surface, but were really very expensive with effective interest rates higher than 60-70%. They disappeared because now it's very simple. You know what the interest rate on your account is. You know that a different bank offers a cheaper one. It's much easier to switch. But sometimes, again, this is not enough, and more stricter regulations that directly target groups that are very prone to this inertia might be necessary.
Thanks, Dan. And John, as a professor of marketing and engagement, what's your view on this question?
I just think the evidence that we get, Dan's already covered a lot of this as well, about the lack of switching behaviors. I mean, we know about this too from utilities providers, insurance providers. It's really difficult and speaks to problems of inertia, understanding, trust, that, okay, you've got the data now, but even if these are temporary, seen as short-lived products, if I'm only changing once every 3 or 4 years, to me, that's probably a longer-term project, a product. Even though I could, in theory, trade out of it every 2 to 3 months or something like that, I'm not actually going to, which is Dan's earlier point about what this market looks like. So how to really understand those motivations and see what one can do with regulation around how often customers are engaging in this market data, how often they are engaging and switching their behaviors where relevant, I think becomes really important monitor and almost like a test. And I think we've seen, as I said, we're learning perhaps a bit more from other utilities, and then understanding financial services in terms of a utility as well. And I think there's some cross-fertilization there that we can benefit from.
Thanks, John. Okay, we've got a great question from Ellen Smith. Ellen's asking, what role can technology and science, I assume we mean data science here, play in shifting financial services from reactive to preventative support models for consumers, and I assume this is a sort of vulnerable consumer focus. So how can financial services be more proactive in supporting those consumers? Cal, I'm going to hit you up first for that one.
Yeah, that's a great question. I think I partially covered this in my last response, but it's actually it's an enormous space actually. So post the 2007-8 financial recession, there were a lot of changes in the way regulations are built and constructed. So, for example, in the mortgage sector, there was a huge shift from reactive model data modeling to proactive identifying probability of default, not only in the next year or two, but even lifetime probability of default. Now, in the context of the current conversation, I think I suppose the easiest answer is, or the most straightforward answer is, everyone should start building predictive models if they haven't started yet. So okay, it's good to react when someone moves into financial hardship, but one of the main points and ideas behind what Dan referenced earlier, the high cost credit review regulation and the modeling that happened on the back of it, was that banks were required to do something about people moving towards financial hardship. Of course, you should always help the ones that are struggling now, and that's probably the top priority in any point of time. However, identifying and preemptively doing something about it, contacting these individuals, offering them alternative products, making sure that sometimes even you can tailor certain products to be fit for purpose for these individuals. That's extremely important. And again, science, technology, data, all them are blended into predictive modeling in this context. And very importantly, it's crucial to have ways to measure the progress and the impact. And that ties back to consumer duty and a variety of regulations. But ultimately, it's important not only for the firms to make sure that they tick the box, it's also important for the society to keep building that trust that financial services firms are actually doing it for their better future, individuals' better future.
John, any reflections on that same question?
Yeah, very quickly. I think we've got a nice parallel here to the advice guidance gap built into the structure here, because a consequence of this is around information, or perhaps what might be defined as marketing or selling, and the different regimes of regulation apply to these different tracks of kinds of communications that are in fact reinforced through the consumer duty. So I think some of the more interesting marketing insights research has been on the sort of engageability of different kinds of messaging and information, especially on the information side of things. So there's some progress being made here using eye tracking and other behavioral approaches to how engaging the information is. But at the same time, it's quite difficult then to flip it into the engagement side of things, because you may well be moving from an information regime in the Financial Conduct Authority world of consumer duty into a sales and advertising regime. Which kind of mirrors a little bit the advice guidance gap, but it's more embedded and nuanced here. So some way of coping with that, I'm not sure what the answer is, but at least we can highlight it for the purposes of this conversation.
Thank you, John. And I actually think, given that we're sitting at 2:57, we don't have any more time for any more questions. But what I'd like to say is thank you to all the panelists for joining me this afternoon. It's been a really interesting and robust conversation. If any of the attendees on the webinar have any further questions, if you scan the QR code on your screen, that will take you through to the white paper itself, which has more information on the paper's authors. And myself, Dan, Cal and John can all be found on LinkedIn if you'd like to reach out and ask any questions directly. But yeah, all that remains to be said is thank you all to our panelists. Thank you, Dan. Thank you, Cal. Thank you, John. And thank you for your attendance this afternoon.